We're proud to have this episode sponsored by ShakePay, the easiest way for Canadians to buy and earn Bitcoin. I love using ShakePay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the ShakePay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, ShakePay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on ShakePay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for ShakePay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, ShakePay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 64. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting and Keith Dicker of IceCap Asset Management. Keith, thanks for dressing up for us today for the holiday show.
I know. I've been dressed up now for a week. That's our thing at Christmas. What you guys? Rich has on his brand new jumper, it seems like.
Yeah.
Hoodie.
Yeah, I got my hoodie. I got my hoodie for Christmas. Thanks, Sandy. She spoiled me rotten, which was really cool. That's it.
Mom got him a couple pairs of underwear.
And my mom got me some underwear.
Did you really? You got the underoos? Did you?
Yeah,
you guys
true.
You got underoos? Yeah. I used to get the Spider-Man ones. They were cool.
No, I didn't get underoos, just regular. I'm not sure that was for public consumption, but hey, it's okay. We're all family here. Merry Christmas,
for all the
everybody.
dates.
Happy New Year. Oh, my God.
At least the underwear will be fresh.
That's right.
Keith?
That's right.
Rich, did you have a romantic Christmas? Was it?
No, not at all. I went home.
No
I went
dates?
home to Canada, as you guys know. It's the off season right now. It's
It's the off season.
Gotta focus on family and Santa and Jesus, if that's your persuasion. Who knows? But it's the off.
So when is the off season over then? In your dating, like you're giving the world a break. For
December
a few days.
26th.
No, let's say the first week of Jan. We'll kick back. We'll get the motor running again.
Yeah. And like, do you have a spreadsheet created with the success probability of success with your pickup lines and
the probability of success? I can tell you the probability of success is 0, so it's very easy to model.
The mind of a CFA.
That's right.
By the way,
right.
Steve, when you put 0 in anything, it kind of screws up the outcome. It doesn't work.
Us realtors don't know that. Keith, what's going on with you, buddy? How was the?
Yeah, we had a real nice Christmas, and this time of year, I like to reflect back on how was the year? Was it fun and stuff? And like my main memory, I think I had about 42 Twinkies during the year. And I think about 4 were with the podcast. The rest were just pure fun. Another maybe 27 lemon loaves. My God, they're yummy. And maybe 2 barrels of Pinot Noir during the year.
Oh, good.
It was a successful year for me.
Yeah, congratulations, Keith. You did really well.
For those listening, Keith's got a very large palate, great palate, sophisticated palate. We went out for dinner in Toronto, and boy, was I out of place.
Oh, that was.
I know how to eat. I know how to eat.
Keith's just disgusted.
Steve eats like a Neanderthal. Though. He uses the American style, just shoveling it. Let's what are we doing today, guys? End of year conversation.
Yeah, we've got an end of year podcast.
Looking forward, all that. Yeah.
Yeah, we didn't want to skip a beat here, so we, appreciate everyone tuning in. Just a reminder: January 4th, I believe that's a Wednesday, January 4th at 4:30 Pacific time. There will be a live Q&A. So there's going to be a link in the description. So if you listen to this on Spotify or Apple Podcasts, there'll be a link in the bio description there of this week's episode. Same thing for YouTube. So you can go and sign up there for it's basically a Zoom webinar. That's the style. So basically just come on, register for the webinar. It'll be like a live Q&A. Come hang out. We'll just kind of chit chat. People will ask questions. We'll have some drinks flowing. I think it's going to be like 1 a.m. Over in the UK where Rich is. So Rich will probably be, half cut for sure. And we'll just have a good time. So go sign up for that. And, we appreciate your guys' support this year. We wanted to kind of make this week's episode. Most people are, enjoying family time, vacations, etc. There's really not a lot of news flow, right? There's not a lot happening in financial markets. We'll kind of go through a bit of that today, but also just kind of, an outlook for 2023. I'm kind of curious what, Keith, Rich, what you guys are looking at, what you're seeing. I've got some thoughts, obviously, on our housing market here, things that we'll be paying attention to. So we'll just kind of do like a year-end wrap-up, so to speak.
That sounds good.
Sounds good.
I'm ready.
Yeah, that sounds real fun. So we're going to do it like not a wrap. I'm never rapid fire with anything. I'm kind of I move along slowly. Is that the process we're going to use here?
Yeah, I wanted to chat. I mean, I guess a couple things here before we sort of get into that recap. But I think we talked about it last week. So there's been some interesting movements. I'm kind of curious your thoughts here. Is the Bank of Japan came out a week ago and said, okay, we're now going to raise our sort of yield cap, our where we allow bond yields to basically fluctuate. And I don't know the exact number. Keith, what was it again? They raised it from like 0.25 to 0.5 or something.
Well, it used to be minus 0.25 to plus 0.25. That was the range that they had. So they expanded it by 0.25. So now it's minus 0.5 to plus 0.5. They widened the range. And that created all kinds of chaos when they announced that. So the stock market got clobbered. The yen went vertical by the same equivalent amount. And by the way, everyone, that normally happens in a market. If the currency moves aggressively in one direction, usually the equities will do the opposite. So that's what happens there. So as a foreign investor, it may not affect you too much. So what you lose on the FX side, you're picking up on the currency, on the equity side and so forth. But this morning, is that what you're referring to? What came out this morning, Steve?
Yeah, I'm just kind of looking at. So yeah, I'm kind of curious your thoughts. So that obviously came out, right? Like that happened, and then if you watch what's been happening in sort of Canada's bond market, obviously the US bond market, yields are up a lot in the last 10 days. So I'm kind of curious, like how much of that are you reading into sort of what Japan's doing because at one point where the narrative was, okay, maybe inflation's coming down, the bond market's starting to sniff that out, yields are now falling. They fell about 100 basis points for in some parts of the curve, and all of a sudden we've got a reacceleration to the upside. So I'm kind of curious how much stock you're putting on that. I know we've been talking about potentially at some point the long bond is going to be a good trade. Kind of how you walk me through that, how you're looking at that these days.
Yeah. So right now, guys, like the last week of the year, liquidity, volumes is pretty low. So you tend to get a lot of, you can get sharp movements in either direction. So I wouldn't put much stock into the last week, especially this week. So today's Thursday, so we got one more day left for the year. That's it. But generally, over this last week, it's been risk off again. So which is, everyone was hoping. I mean, I keep saying hope is never a great strategy, right, Rich? Yeah,
right.
You're hoping for first week of January to pick it up again. But guys, like this was a crappy year. But the move, in the bond market over the last week, I think it's just a little bit of squaring up where we are because there's no data coming out. And so the Japanese news, though, to come back to that. So like Japan is a completely different market than everywhere else because they completely try to avoid price discovery. And, for everyone, price discovery means you get an accurate price of something. The buyer and the seller, they meet and they say, yeah, this is what we'll agree to trade your house at, or your car, or bag of chips at the store, or whatever it's going to be. And in Japan, because they suppressed price discovery for the bond market for so long, and they finally allowed it to nudge a little bit closer to what reality is. It made that initial nudge. Now everyone has suddenly said, wait, it's still not truly reflective of where it should be. So, the Japanese, the Bank of Japan, sorry, they had to come out aggressively again this morning and not spend, 10 billion to try to support the bond market. They say we're doing unlimited spending to support the bond market. So Japan should be high on everyone's list as a potential market that, even though they may contain the risk on their side, is going to create chaos somewhere else. So that's the big thing with Japan this week.
The other thing this week that happened, again, in a week of low liquidity, and Keith's right, we shouldn't read too much into it, is what's going on in China. And how they're opening up. So we went from COVID 0 to COVID 100, I guess is what we would call it. I don't know. We have to think of something a little bit more pithy than that, but it's actually amazing what they've done. To the point, I think I've read numbers of like 100 million people with COVID. I mean, yes, there's a lot of people who live in China, obviously, but it's just incredible. The headline that I thought was kind of hilarious and sad and kind of quite telling is how the Italian authorities are now testing anyone who flies in from China. And so it's amazing how far we've come. And it's just, and then obviously everyone, there's people, my colleagues and former colleagues and friends of mine have been calling me, asking me how it's going to affect whether the oil market or the view on inflation. I don't know yet. I haven't quite figured it out, but it's something I'm thinking about. Steve?
Well, it is fascinating because right now with China and, things always, go 360, or as someone said to me once before, yeah, I did a 360, turn my life right around, to which I would say, you're right back to where you started. But you remember though, you back in the early days, the pandemic back in 2020, I think it was February, I'm on one of these chat groups, and guys from all over the world, and one was the Sunday afternoon, he said, hey guys, emergency chat call, And this guy was based in Milano, and he explained then that, they're closing, northern Italy, and everyone was running because it was ground zero. And They determined afterwards that a lot of the COVID, it developed from the Chinese. I think it was workers that were coming in.
That's right.
I'm not quite, is that right, Rich?
There's a huge industrial base in Italy that is and they're either owned by Chinese companies, or there's lots of Chinese workers that fly directly from Wuhan to Milan. There's like a direct flight, believe it or not. Anyway, sorry, keep going.
Okay, yeah. And anyway, so that's what happened. And now all of a sudden, as you're referring, Rich, over the last 24 hours, they're now reporting the exact same thing again. So I think, one of the early things to watch now, especially here in Canada, because we know how Ottawa feels about it, the moment positive COVID cases start to escalate again, it's going to go up. I mean, we know that's coming. I suspect some countries they'll try to be very aggressive again with their policies towards it, and others just won't care. And I think markets may or may not shrug it off. We'll see. But as for, the aggregate effect on the economy and stuff like that, I think, if the Chinese are back working again, it's going to be great. We'll be able to get stuff because we need stuff to do things. And, but we'll see. But I don't think it's going to be this, this incredible wave that's been generated that's going to, ride everyone into victory into 23. I think it's a lot more other factors coming along. But you're right there, Rich. Like that is one of the key things we're looking at here, as we chat here today.
I don't want to talk too much about COVID. I'm really, really interested in putting that behind us in 2023. But there's loads of interesting things that I think we could discuss. And I don't know, Steve, are we ready to do a little bit of an outlook, even though I usually hate doing those kinds of things? And my old job, I had to do like an annual outlook and a 5-year outlook. And of course, what's Mike Tyson's quote? Everyone's got a plan until they get punched in the face. So it's you always have to be careful with these predictions and these outlooks, but it's fun doing it. And it's a good year-end exercise, I think.
Yeah.
But it's good because it gives people things to think about. And that's what the investment world is. You're not going to be right with everything. And as long as, some will say if you're 50% plus one right, so you cover your losses, you minimize your downside and you expand your upside, then, that's great. But the main thing with these exercises, though, is Rich said, you get to discuss things that, three great minds are thinking about right now.
Oh, I don't
Or
know. I
maybe-
don't know about that. Based on the
maybe-
YouTube comments, I don't know.
Maybe two, maybe Rich and one other. I don't know which
Ah.
one, Steve. But yeah, so let's have a go at it. And I think mine and Steve's might be a bit shallow and thin, and Rich is going to go heavy on us on something. So what do you got? Who's going to kick it off?
I mean, are we going just predictions or just sort of outlook on the market here?
I think you do a bit of both.
Yeah, a little bit of both.
I don't know. I think it's going to be yeah. I mean, I was going to chat just on like the housing front, I suppose.
Why not do it? I'm curious to hear
where I feel I have the most credit and sort of maybe insight that I can actually provide. Yeah, I think it's going to be a lot more. I think it's going to be a challenging 2023. I think we will definitely see an increase in sales volumes. You've got, but we just talked about it last week, over 800,000 new people into the country. And you've got home sales in the GTA running at levels last seen in the 1990s. Clearly that's not sustainable. So once you get these buyers off the fences, you'll start to see transactions pick up. But I think that's, the way to get people off the fences is for them to sort of feel some comfort in where interest rates are going to sort of settle out, which I think we have clarity on that. I think the Bank of Canada is done, or maybe another 25 basis point, which is kind of what the market's expecting. And then also, lower prices. Lower prices ultimately will entice people back into the market. Again, it's not going to be a bull market, but I think we'll see an increase in sales volumes. It'll still be well below, I think, 10-year averages. But I think the trend here, I think, is really, I think there's a lot of pain that's going to be felt. I think that.
So Steve, has the low been, was the low reached in 22 or is it 23?
No. We get the low. I think the low will be in 2023. I don't know
which month.
Yeah. which day,
which neighborhood in Kitsilano.
Yeah, I don't know. I don't know when. I'm really struggling with like the when and the how. Like it just depends.
Run us through your thought process. Like give us some, like, sometimes when I'm trying to think of not predictions, but I try to set myself either signposts or things that I'm looking forward and looking for that will help me confirm or deny sort of my view. What are the let's say 2 or 3 things that you're looking to see that will confirm your view or change your view or blow it up or altogether or whatever?
The big one would be, I think, mortgage rates with a 5 handle in front of it they're too high. The market can't absorb those rates especially in Vancouver and Toronto. Those are the 2 markets. So Calgary's absorbing them and more or less just fine. So that's the market. I think the other thing you'll be looking for is like, what are inventory levels looking like come March, April? Because that's your typical busy listing season. So are we going to get new listings back to where they should be around a 10-year historical averages? Or are they going to continue to run at 20-year lows, which they have been over the last 6 months? So if you get like the normalized inventory levels into a spring market where, let's say, demand is weaker than it normally is, then all of a sudden you're talking about excess inventory that starts to build and puts more downwards pressure. Because again, it's hard to get people to cut their prices when there's no other neighbors for sale in the neighborhood. They're like, well, I've got no competition. Why would I cut my price? But all of a sudden, if John down the road sells his house for 2 less because he's in a panic to get out of there, then it sort of starts to reprice the neighborhood. There's actually they say that typically you need 3 comps. 3 recent sales comps to actually reprice the neighborhood. So if there's like a one-off sale where some guy panics, doesn't typically reset the neighborhood. You typically need 3 people to reset it. So that's kind of what I'm watching. I think.
You mean neighborhood? Sorry to interrupt you, but you mean neighborhood as in like sort of not like a sort of like a several block radius type thing, right? Like
what? Yeah, exactly. Like what's your sales comp, right? So if like in Keith's neighborhood, like which is like the glitz of Halifax, like in that little pocket, if there's a similar house that 3 of them that sell at a certain number, that will reprice Keith's house.
Just to be clear, there's only one house in my neighborhood. That's it.
On top of the hill, surrounded by a moat.
By the way, what's like Steve lives rent free. I live rent free in Steve's head. I think that's what's going on.
That's right.
Yeah. So I find that interesting, and I think everything gets tied together in the real estate, economic, financial world, and so you can't have a separate view on the housing market and an offsetting view on the economy. I think it's all going to be completely linked together.
I have a question for you.
Yeah.
Do you think there can be disconnects in like the equity markets versus like the housing markets? I always look at it and say, well, did the S&P 500 perform relatively okay while Canadian housing drops, another 10% this year?
Oh yeah, for sure. Yeah,
I think
right.
so.
Equities can go completely in a different direction than the real world, because okay, children, the stock market is not the real world. That's the thing to think about. No, I want to get the CFA suit's going to call me and like suspend me or something.
Because that's kind of my view, right? I don't know. I'm definitely. I would still be.
Well, that cannot happen, because remember as well, I keep going back to the whole concept that the world has never before been in this situation where everyone is coming off ground zero with rates. Like debt loads have grown exponentially during that period, and like everyone's living on edge in terms of economically and stuff like that. So we can definitely have a bizarre marketplace where equities are going in a direction that it doesn't reconcile with the way you've been told that you should be thinking. So for my big thing for next year that's coming up, and what, my mind we don't work in absolutes, it's in the probability range. And in our view, our base case scenario is that we are going into a recession. And so whereas a lot of other places that's not their base case. The base case is maybe a slowdown, low probability of recession. If we get this recession that I suspect we're going to get, it's going to be hell for the real estate market, for residential as well. And so that's the base case to look at. A lot of recession models that we use, they're based off the U.S. economy, which is incredibly dynamic, more dynamic than any other economy around the world. So the Canadian economy can have something a little bit different than the American experience. But I'm seeing, as I know I shared with you guys this morning, two different models. One was showing that, the recession is guaranteed. Another one is showing that it may not even happen. So again, that's the kind of world we're in. So with that premise as my base case, we are going into recession. One of my expectations for 23 is that the stock market, all right, so you want to depend, it doesn't matter which one you use, because correlations go to 1 in every major event. We suspect that equities could come down another 25% during Q1, Q2. We don't know if it's a gradual trickle lower or you get a couple thumps along the way. But we've never had a period where, so Ned Davis is one of our research providers. They did some great work just recently, but they show that equities never bottom before a recession begins. It always bottoms a little bit. And remember, recession data, though, it's in hindsight. It's not real time. So that's why people think equities they do bottom before, but that's not the case. The average correction, the range has been from minus 13% back in the 50s to about minus 53 back in 08, 09. So it's a pretty big range what the correction has been. So when I say, hey, we could get another 20, 25% lower in the equity markets, that's sort of the first volley I'll give to everyone here. So don't be surprised if we get more equity market weakness. If that happens, then I can see equities just doing a slingshot higher after that. And it could be like a 50% or 40 or 60 or something like that. So then trying to time that bottom is going to be pretty difficult. However, that's the path that we're expecting. And the path that we just went down in 22, like we were pretty accurate with that. Like we had a pretty good year. Performance wise, we've done pretty well, and but we're starting to see a continuation of that wave going into next year. So that's my first forecast, I guess, is that equities have not bottomed yet, maybe Q1, Q2, and then, slingshot higher based on we're going into recession. And that's the key thing, because if we do hit a recession coming up, it's just gonna swarm a lot of other markets. How about you, Rich? What do you think about that?
Yeah, sure. So I mean, I got three of them, and we can hit one at a time, obviously, and we're gonna go back and forth. Yeah, shoot. Sorry.
Can I just chime in quickly? I think it's important to like contextualize here, because you're just reading like a lot of the comments, whether it's on Twitter or YouTube or whatever. I think there's like a lot of people. I'm like, we chat with people at our events, and like, I think there's a lot of people out there that are genuinely like wanting to learn. They're generally wanting to maybe be better investors or manage their money a little bit better, or understand like where the risks are. And then you have like the cohort of people that I find are just like looking for like someone to forecast and be right. And it's not about like being right. It's just about understanding like the risks and figuring out where the probabilities lie, and ultimately, protecting that capital. Right. So it's like these forecasts should never be looked at as like, well, you said this and then this happened and you were wrong. It's like, you're going to be wrong at least 50% of the time. It's more of like, when you're right, like how much are you capitalizing on when you're right, and how much are you losing when you're wrong? That's really what it's about. So guys, stop looking for us to, forecast, or for anyone for that matter, following people because you're hoping to get like the right answer, I think is the wrong way to look at it. I think we're just trying to sort of expand people's horizons and provide some insights where we can, but we will and have been and continue to be wrong in some circumstances.
That's well said, Steve. I'd also say we've also been very right about certain things, but
the reason why I bring that up is like the one thing that was like the one thing that always like kind of brings me back, and like Keith and I were chatting about this offline. Like there's like this account that was like, I remember, like I'll never forget. He's like on Twitter, and he's like digging up like some of my old tweets where I'm like, oh, you wrong. And then he tracked down like Keith, like, no, but you don't chirp Keith. Guy's like the nicest guy ever. And he like pulled out some of Keith's tweets where like Keith was like wrong on some I think it was like on rates or something. And I was like, who cares? Guys year-to-date performance is positive. Like, who cares if he's got like people
in a world where everyone else is negative, by the way, to put that into context. Not that this is
insane. It's like, doesn't matter.
Pump
like, let's
Keith
just talk
Cyrus
about,
too much.
No, let's just talk about like performance. It doesn't matter, right? Like, people are going to be wrong.
Yeah, it's a good point, Steve. Thank you for the kind words. And I just think today, and I've said this before, the world is so squished together that creates really good opportunities to structure your portfolio, to consider all of these risks that are out there. And that's what we talk about. And again, in our world, like when if you're in that world managing money in a sort of global macro way, you always deal with probabilities, and there's never a 1% probability like in the market space. And as long as you're thinking about that risk, because the thing that a lot of people get wrong is that they believe if a risk doesn't happen, it wasn't risky to start with.
Right.
And that's not the case at all. So why else would you have car insurance, house insurance, and stuff like that? But again, I think that's why these great opportunities are coming up. So okay. Rich, what do you see there?
So I think
Magic. I like remember Magic 8 Ball says, do you remember those?
I love that. That was a great toy. I got that in a stocking one year. But anyway, so one of the themes that started, I think, in 2021, and I think will carry through to the end, or at least hopefully until the end of 2023, is sort of rotation. I wrote a note on it. You can find it on my Substack probably. But I wrote a note on it. It's called, and the title of the note was rotation. And it's a theme. And when I outlined 3 portfolio construction rotation themes that I think has worked out the way I expected. But the reason that's not why I'm bringing it up, because I think that there's still more, juice in that lemon. And I think that one of the rotations is, for example, from value to growth. Sorry, I screwed that up. From growth to value. So that was like a very, very important portfolio construction consideration. You have different types of styles, factors, sectors, and obviously you have country allocation when you're thinking about investing from an institutional standpoint. And I know Keith thinks about these things too. And one of the major rotations we saw last year was away from growth. So growth is just broad strokes here is like tech names, consumer discretionary stocks that are very highly levered, expensive, away to towards value, which might have been energy. You throw banks in some of those cases, in some cases, some financials, consumer staples, stocks. And I think that we saw a massive outperformance of value relative to growth in 2022. And one of my key themes for 2023 is the continuation of that. And we'll obviously see. Related to that is sort of cyclicals versus defensives. So a similar theme, related in some ways, but again, if you think that there's the economy is slowing, you think there's a recession, I think that the defensive sectors, and these include healthcare, utilities, consumer staples, and then et cetera. You can Google that. I think that you're going to see a continuing outperformance of defensives versus cyclicals. So cyclicals might be, you might consume consumer discretionary, whatever. And so I think that that's a really, really important sort of change. And there's another rotation that I think is going to manifest itself. And I'm curious to see if Keith's going to push back on this. And it's going to be away from the US equity market towards global ex-US. And I think that that's something that's been sort of people have been predicting for a long time and have been getting it wrong. But we're finally starting to see the change in leadership. And so the reason the US did so well is because it has a number of tech names and a number of consumer discretionary names. So Tesla, Apple, Amazon, the list goes on and on. And those have had a significant, they're retrenching and they've retraced almost all of the gains that we've seen over the last 2 years. And I think that coupled with, the rest of the world being so cheap and interest rates going up, I think that we're going to start to see the beginning of sort of the end of the US leadership. Now, there's been times that this has happened before, from 2000 to 2003 or 4. You had Europe and the rest of the world outperform. It happened again, sort of again in the late 2000s. So these things do happen. You have like a rotation from one country to another or one sector to another, and that's one really big theme that I'm really, really keeping an eye on. And then maybe we should do this like a snake draft. I'll just pass on to do my another one, and we can get back to Keith on the way. And then the other thing that I think is really important is from an economic standpoint. So the first one was sort of a markets thing. The second one was from inflation to disinflation. And that's just something we can't sort of ignore. There's been so much talk about inflation this last year. We've talked about it ad nauseum. And what disinflation is just falling inflation. So your number is still positive, but instead of the line on the chart going up, the line on the chart is going down towards what the target is. And so again, Keith said, if you have a sort of a worldview or a construct of how you think things are going to play out, they have to coincide. They have to make sense logically. So if you think that there is going to be a recession, well, it's highly likely that you're going to have some kind of disinflationary impulse. And so that's one of where I agree with Keith. I think things are really slowing, and then there's a high probability of that happening. I think the math is very clear on the disinflation, which is, I think you're just going to start seeing all of these CPI curves. If they haven't already peaked, they're going to start peaking and they're going to start to come down.
I think that's important, Rich, is just because I know you're running the data, right? Like, that's your whole job is like, and so I think we've chatted about like rate of change quite a bit. And so are your models or is your data still suggesting, like, from a rate of change perspective, that inflation is going to continue to roll over? Again, doesn't mean prices are going to get cheaper, but they're going to stop going up as fast as they were. And they're not going to go up 9-10% a year. Right. They're going to go up 1, 2, 3, 4% a year. Where are you seeing? Are you modeling where inflation is going to sort of level out? Is it going to come back down into the 3s, the 4s, back down to 2?
I do not like to make forecasts because I think people get married to their forecasts. I think you start to defend your forecast instead of think about what the right answer is, which is similar. And so that's a dangerous game to play. And I think it gets you really into trouble. But I think it also
demonstrates Rich's fear of commitment.
No,
see what I mean?
No.
Anyone on Tinder is listening to this.
Oh my God. No, I just listen, you totally, I'm off my game now. I think there's a way whenever things are very low and they go up, everyone talks about base effect. So I remember in 2020, inflation was starting to rise, and anybody who disagreed with the inflation narrative, Bank of Canada, said, "Oh, it's about base effect, and that's a fancy way of saying, the number, the rate of change is really high because you're where your starting point might be low." And the same thing, by the way, is true when you're coming off. And so what we're seeing now is, inflation in Canada, the core inflation is 5.8, and my models, whatever you want to call it, say, we're still going to be in the fours by the end of next year, and that's a significant sort of decline, but it's still well above target. And I think that's a really, really important. So that's the disinflation piece, right? You've off that peak impulse, but we're still well above target. And that's, again, back to this transitory negative that I always thought was bullshit. I mean, this is that piece. You're well above target, and that's really hard to it's really hard to get out of that lane given the constraints we have with just purely the math.
Which is amazing, though. Like, if you're still sort of modeling, again, it could be wrong, decent probability of that. But as of right now, you are modeling that core CPI in Canada will still be in the fours by the end of next year.
Yeah.
And I don't know what the Bank of Canada, isn't the Bank of Canada saying headline inflation by the end of 23 will be back down to 2?
I will bet.
I mean, but that's
who's
what
listening. I'll bet anybody who's listening a beer. I'll bet him a beer that's not happening. It's just that it's not that it's like impossible. Listen, if there's a media, again, to quote Mike Tyson, everyone has a plan until they get punched in the face. Like, something could happen that could dislodge all of this stuff. I mean, if there's a meteor that hits Ottawa, who knows what inflation will do? But my point is just it's about probabilistic. It's about what the distribution of potential outcomes is, and you can see
severe recession.
Yeah, I guess it's possible. I just think the numbers are such that it's hard for that to happen. And I guess that's why I'm pretty confident that number is going to remain quite high.
Keith, you want to chime in on that? I'm curious your thoughts.
I mean,
do you have a strong view on inflation or disinflation or
No, not really. I think the numbers will come down. I do understand the way the maths work with it. So the numbers will continue to come down. If we go into recession, that will allow the inflation data to get a little bit weaker still. But it sort of ties in, and one of my thoughts is that, if we get a lull in commodity prices coming up, which is, what we suspect, especially on the oil side, I think that stuff can sort of follow equity markets when they slingshot higher as well. And then we'll be back into this whole inflation drama again. So I think 23 is going to be another year like that. Yeah.
Volatility.
Yeah. So I understand what Rich is saying. I do agree with it. I just think that we just got to be careful with the whole. People are so focused on inflation data now, solely in the investment world, solely for one reason. It's because it's going to give them a guide to when central banks are going to pause what they're doing. That's all it is. Otherwise, headline inflation data, it never reconciles, with what we're paying for stuff. When we go to the shop and everything. But that's the key thing. So I do suspect it'll get weaker, and then the markets are going to anticipate the central banks will have to do this pivot they keep talking about. But it's not a big thing on our radar right now. I'll go back. I have another point,
Can I chime in quickly?
But it is your turn next. Like, what do you have?
Well,
Steve?
no, as I was, Keith, I kind of want to ask you, as I'm sure the audience is probably wondering. So do you foresee, so let's say Rich, we've talked about this basically throughout the show here today, which is, okay, I think we're all in agreement that recession is more or less likely. The severity of the recession is what's sort of up in the air at this point. Keith, you think there's a potential for a more severe recession? And Rich is saying, well, core CPI in Canada will still sort of probably more or less maybe hover in the fours. Do you foresee a situation like in your sort of maybe forecasts or outlook that central banks ease? Do they ease into inflation still being relatively elevated because of liquidity issues, financial systemic concerns? How do you foresee that potentially playing out in 23?
So I think it's an extremely low chance central banks ease if we just go into a normal economic cycle. That's it. The only way, in my view, the only reason they would start cutting rates is if we go back to another severe crisis again. But at that point in time, it's going to be different because they'll have to decide, do they want to rescue their currency? Because if you start cutting rates aggressively, and because your country or economy is experiencing a crisis, and you're the only one experiencing it, the moment you start cutting rates, your currency will just drop like a stone. But if everyone is experiencing it, you go back to this 2020 scenario where everyone's cutting rates at the same time. So if there's no crisis, no rate cuts, it'll be, I think the average is it 5-8 months, before they would start to change rates again. And that's what that's what the market is expecting right now. And whenever the market expects something, you should expect something different to occur, right? That's the way it's going to move. So again, for everyone, don't expect the Bank of Canada, and they do a rate hike, in January, and then in April they start cutting again. I mean, that's not going to happen unless there's a major crisis out there, like the Canadians start winning or something.
Oh, come on. We got a tank for Bedard. Was that his name? What's his name, Steve? I forgot. The kid is amazing.
Bedard.
Yeah, he's amazing.
Yeah, he's
I want a tank. I want the Canadians to lose. I can't believe I said that out loud, but it's true.
Okay. What do you have, Steve? What do you have? Another thought for 23?
I mean, I guess maybe continuing on that theme, I think yields, bond yields anyways, which are correlated to mortgage rates. I think mortgage rates are going to come down. I don't think they're going to come back down levels that are going to be bullish for the housing market. I think we're still in the 5s right now. We were seeing a little bit in the 4s if you got into an insured mortgage in recent weeks, which is something we haven't seen in many, many months. But I think mortgage rates, next year, more or less for most of the year, I think are going to be probably in the 4s, maybe in the low 4s. But even mortgage rates in the low 4s is still, I think, a bit of a headwind for the housing market. So that's kind of my
especially
forecast.
If there are job loss. I mean, if there are job losses coming up, which is what happens, recession or like no bonuses or wage hikes, then I mean, that's soft as well. In my world,
that's a very good clarification, because I've had people be like, "Oh, how is that? Like, you're just trying to pump." No, I'm saying like, the only way to get like rates lower, right, is like a weakening economy, and that will coincide with job losses. So it might be good if someone has a steady job and they have a mortgage coming up for renewal, then they'll be able to renew at not 5 but 4.2. And but it's not necessarily going to be great for people selling their houses.
So can I jump in there? Sorry, can I jump in there? Because that reminds me of my theme. Sorry, Keith, I know I'm biting you, but my theme is the Great Reset. I think that's something related to Steve's point, which is why I had to jump in there, which is we haven't really seen the full effect of interest rate hikes. And I think one of the themes for 2023 on my radar is how that finally starts to feed in. Because whether it's, friends of mine whose mortgages are about to go up by 1,000, Keith, you mentioned a couple of months ago that your friend's mortgage had to jump significantly. That's just the housing sector. What about non-financial corporations that have new bond issuance at much, much higher rates? So that's sorry. I'm sorry I interrupted you, but it's just, I think it's related to that piece.
Here's this. So mortgage delinquency rate in Canada is at 0.14%. That's an all-time record low. Now, however, this is very much a lagging indicator. First of all, because bank reporting requirements. So some mortgages aren't reported as delinquent until they're 180 days late. So this is certainly not a leading indicator, but mortgage delinquency rate as of today is at all-time record lows, and we know that's going higher.
Yeah, usually when you get to 3 months, that's when you have to start, thinking about it. But the other side of the mortgage coin, instead of looking at it in terms of the demand for mortgages, you also have to look at it on the supply side. And again, if we go into this, my base case view, banks are going to be less willing to extend credit to give people mortgages. They always will, of course, but it'll be at their price. And so Steve, you suggested maybe rates won't go too much higher. In my mind, if we hit a recession and it's a bit deeper than what's expected, the credit spreads offered by the banks on mortgages could actually be higher. So, and again, it doesn't mean it happens, but if, again, everyone needs to be acutely aware of where the economy is headed. And don't just look at Canada all the time, because the recession can get triggered from anywhere. Because we are in this global world, it sounds, cliche and everything, but it really is. So the next thing that I want to introduce is this same concept. And again, I keep going, from an investment management perspective, everything is tied together. So, now, like, my view is that, hey, the economy could roll over here. You then have to look at two things. One is earnings expectations. So for people that think that earnings drive stock prices and all that, stuff, right now, prices have come down with markets, but earnings estimates are still pretty high. And the way the cycle works with earnings, analysts take their estimates based on guidance from companies, and company guidance a year out is always optimistic. You're never going to say, yeah, we're not going to grow that well. So if you like one chart that we call it the squiggles. I don't know if you know that one, Rich, when I say that. So you see the earnings estimate for a quarter over time, how it moves. And it goes up high first and then starts to come
I
down.
know exactly.
Yeah.
We can share that chart. I know exactly which one you're talking
Yeah,
about.
I call it the squiggles. And but that's going to happen. But right now, earnings estimates, they're really high. And if there's no recession, if we get just a slowdown, earnings estimates, they're still going to come down 8 to 10% from the current levels. This is on the S&P 500 operating earnings. So they're going to come down. If we get a recession, earnings could come down 25% or more. I mean, that's the type of thump. So then, then that's when you go back to the whole valuation argument. And, that's where Rich and I differ. Like, I'm not a big believer in, something is cheap, because you're basing something cheap that's based on an earnings estimate, which is based on, something that may or may not be there. But then the other side of this from a market perspective, because remember, we're not a firm believer that earnings are going to drive stock price. We think other factors will drive them. But what the market that earnings will drive will be in the corporate bond world. So you have to break that down between high quality bond issuers, or investment grade, as we would call it, and then the high yield space. And if we start to see earnings estimate come down, into next year, then I think the opportunity for the corporate bond market, or credit markets in general, you want to call it, I think it could be another real tough year. And they're probably down. I don't know the number here now. Maybe Rich, you can find it. But like investment, look at LQD, maybe, Rich. That's probably down 15% for the year, 20%. I'm not quite sure. I don't remember offhand, but we could have that kind of a scenario again. And then you go back and say, why are earnings coming down? They come down for two reasons. One is top line growth that's coming down, but the other is the margin impact. And we all know now that the cost of everything is going up. So we're paying more for stuff. Companies have to pay more for stuff. But one of their biggest input costs are wages. So if wages now, because remember, it's a lagging indicator. Everyone got pay increases. The pay increases that come into effect next year is because of what's happened this year. So again, we're just coming into this world next year where I think government bonds could do quite well, if it is a recession, because, that will get bid. But the corporate bond market, like, my God, that could be 2 years in a row where it's, hey, like the bond market. What do you got, Rich?
Yeah, so LQD, which is an ETF that you guys can all track on, is down almost 20% exactly. And then there's the correlate. That's a US investment grade bond that I track all the time, because it's just something you got to. It's nice. It's an ETF. It's liquid.
What's the yield on that bad boy right now?
Oh boy, you got me. I think you got to check. It's probably very high actually. The yield, well, it's a dividend yield, so it's not technically the same as the yield to maturity, but the dividend yield on this ETF right now is about 3.8%. The other one, sorry, just to round this home, is the HYG, which is the high yield. So same type of instrument. And that is yielding 6.4%. And that one is down, oh geez, I don't know. I can do this quickly. If I can do
No,
this,
it's just curious. I just
it's probably 1 point. Sorry, if I can do this.
So what's interesting about this stuff, you get these cyclical
15%.
movements, and if say equities come down in Q1 and Q2, and high yield will follow it down because high yield, it's just a real sneaky way for bond managers to get equity exposure. That's all it is, because high yield has a high correlation with equity markets when equities are going really well or very poorly. So just as I said earlier, we could get a slingshot move in equities next year. If that environment starts to play out and there's not a lot of defaults taking place in the high yield sector, then that market could slingshot higher as well. And that's my point, that like no matter how great or bad the world is in terms of financial markets, there's always a place out there where you can do things. And I know, Rich, last week you mentioned that you'd always be invested and stuff like that. We differ with that view. That view is correct for institutional managers, but for individual clients, and that's what we manage money for, we will always use cash as a tool or a weapon, maybe. Yeah. But it's coming up. But that's the next thing. Again, see how like the economy is going to affect equities and commodities. The inflation story is on top, and credit markets as well.
Well, it's something that people should know. So what you were describing is sort of the capital structure of a given company, whether they're non-financial corporations or financial corporations. You have sort of the lowest risk, lowest cost, and high priority in a liquidation event. So when you go bankrupt, who gets paid first is senior debt. Then you have something called subordinated debt, or you can call it mezzanine debt or whatever. And then from there, you've got, convertible or equity, and then you got preferred equity, and then you got common equity. So the common equity is the highest risk, the highest cost from a financing perspective, and the lowest priority in liquidation. So if your company goes bankrupt and you need to liquidate all your assets, those are the people who get paid the last. And commensurate with that risk is your return. And so the high yield corporate bonds are trying to have it both ways. They want that yield, they want to be paid if things go bad, but they also want the returns of that common equity structure. What happens, but that's what Keith was referring to, which is called the capital structure of a company. Sorry, Steve.
I'm kind of curious, on Keith, you're talking about sort of forward earnings and expectations, and I'm really curious to see what the retail sales come out for the month of November or December. It's just. It seemed anecdotally anyways, everyone I kind of talked to was like, yeah, we spent less at Christmas this year. And then then you see the pictures and the lineups at the malls for Boxing Day, and holy moly, it was packed. I think people were talking about record Boxing Day sort of activity levels. And so I'm kind of curious, is that people just literally spent way less at Christmas because they needed the deals that were coming out at Boxing Day, or is the consumer maybe more resilient than we're being led to believe? And does that bolster the case for higher for longer rate interest rates? I'm really curious how that data sort of comes out.
Yeah, I don't have a strong view on the holiday, because Boxing Day shopping, it's always crazy. Anyway, by the way, I haven't been to a shopping mall in 18 years probably. So it's
you let Mrs. Icecap does all the shopping. Come on, shame on you. She buys her own Christmas gifts. She buys her own Christmas gifts.
No, but I'm not the big, the anecdotal for shopping is the other way as well. You always remember, an asset can be supported by debt. So even though shopping has been strong, as you as a proper analyst, you're going to look at retail sales, but you also have to look at credit card growth and stuff like that on the banking side. So, you can max out your cards as much as you want, and retail sales look great during that environment. But, you're right, Steve, we'll start to see a lull. And the other big thing as well, I think we mentioned this a few months ago. I know anecdotally, some pretty large companies, their inventories are just, bloated. So they got to blow this stuff out. And that's the sign of a recession coming, right? They order too much in anticipation of a growing economy. It didn't grow as fast or as quick as they thought. But so what did you buy, Steve, on Boxing Day?
Well,
was it a snow shovel, right? You needed a snow shovel.
Look at the chartered bank credit card loans. They're up in a big way in Canada in the last several months. So clearly people are, I think, starting to struggle and tapping onto those credit cards. So maybe that could be what's driving some of the Boxing Day stuff, is just adding on more credit card debt, which ultimately is a tough way to sort of get pinholed.
Wait, let me just interject there, Steve. What's fascinating about that particular point that you're making, which is true, which is as mortgage lending has come off, credit card lending has started to rip. But remember, we know the retail sales per capita in Canada have stalled. So people are borrowing more just to keep up with, do you know what I mean? They're not do you know what I'm saying? Like it's a weird kind of contrast, right? There means somewhere their sort of real disposable income, let's say, is clearly being affected, whether it's because of inflation, whether it's because of maybe they're losing we know job losses haven't started in Canada, but it's fascinating to contrast those two data points, which is falling real per capita retail sales with much, much higher credit card lending.
Well, I mean, exactly. The reality is like you can't tap your home equity line, or you can't refinance your home in this environment. So you're switching over to the credit card to basically spur more spending, which is interesting. So, it seems still very, very early in terms of the sort of credit cycle for the Canadian consumer, and to sort of see where it all sort of settles out. But it's going to be really interesting 2023. I don't know. I think that's a good place to wrap it up. I don't know if you guys have any sort of further thoughts or interjections or any last comments here as we head into.
I have an end of year Super Bowl prediction, because it's
yeah, you did it last year.
Yeah, it's going to be San Francisco 34, and the Bills Mafia, Buffalo Bills 24.
They're going to lose again in the Super Bowl.
Yeah.
Aren't they 0 for 4?
They are 0 for 4. Yeah. It'll be in Arizona this year. So anyway, we got the playoffs starting in a couple of weeks, and
sensing a little bias. Are you going to Arizona if they make it?
No, I'm not biased with that. This team's defense is unbelievable. So am I going to the Super Bowl? I would only go under two conditions. One, the team I like is playing, and two, someone can find me tickets. Anyone?
Just to say, two must be a bull market.
It's like, if a family of four went to the Super Bowl this year, I bet you're going to pay at least 20 to 25,000 USD.
But don't we know there's a recession coming?
Nothing. It's important, Steve. So it was just kind of ironic, right? Just say Buffalo, they do get to the Super Bowl, and I don't know if you've ever been to Buffalo before. I have. It's a fun place, but I'm not seeing a lot of economic success there. So credit card usage is going to be going up for those guys.
That's like that meme that was circulating on Twitter. There was like, the cheapest Taylor Swift ticket at any concert in our upcoming world tour was like $3,000. Someone was like, we need to raise more rates more. Yeah, it's insane. So I don't know, maybe this is a new sort of inflationary world that we live in, which is people are splurging on experience.
But Super Bowl is different. It's supply and demand. So there's only about 70,000 tickets. However, I bet you there's only about 10 to 12,000 are actually available to purchase. The rest are already scooped up. They're never going to trade. So then you get 400,000 people. They're trying to chase these 10 or 12,000 tickets. It's like the Japanese bond market, right? Something like that in a reverse way. Yeah, absolutely. Okay.
Well,
we're just getting lined up for 23. I like that.
No.
The enthusiasm. Good. So, Steve, obviously you're not in Vancouver there right now. I can see some
palm trees,
water behind you and
Palm
no
Springs.
Snow. Yeah,
the show must go on. So, we're just gonna hit the golf course here after this recording. So, we appreciate everyone's support. Like I said, we wanted to continue to pump out the content while while we're here during the holidays to give you guys some easy listening and hopefully some forecasts. Please don't hold it to us, but it'll be interesting to sort of, turn back the clock 12 months from now and see how we did. But either way, I think we can all agree that 2023 will be another year, unfortunately, of volatility and opportunity that comes with that. So hopefully you guys can continue to sort of tune in, and we can sort of be, a voice or a guide to try to sort of navigate through the mess. And, we continue to appreciate your support. Looking forward to everybody, coming to the live Q&A webinar. Again, there'll be a link below. That'll be next week, January the 4th. And we're just happy to sort of engage with the community, answer some questions, and have a little bit of fun. So as always, we'll see you next week.